Hey there and welcome. Thank you so much for joining today. So today we're going to talk about an introduction to net lease, what it is and how it works. Okay, we're going to get into the 7 points and some of the pros and cons about net lease and why you should consider it if you're looking for cash flow, especially considering where we are today in the economic cycle. So before I get into that, I want to tell a little bit about me. Okay, so who I am. I am a multifamily syndicator primarily, so that's why I started in this business, right? We started acquiring multifamily assets, B and C class type of stuff. We've been doing that for quite a while now. We have about 1,600 units in and around Cleveland. We shifted to development, so we also buy office type of conversions and also do ground up development as well. So all told, just in those two businesses, we've done about $350 million of deal flow already. So we have quite a bit of experience doing large commercial deals and small ones as well. Our newest part of the business is the single tenant net lease asset. And the cool thing about single tenant net lease is that it's one property. Think of it as one property on one parcel, and it just cash flows. And the cool thing about it is that the tenant that's currently in there has a lease that's backed by a corporation with a lot of money, very secure. Okay, so we're going to get into some of the benefits as to why that's important. Okay, so before I continue though, I have a favor to ask you. Okay, we put a lot of this content up on YouTube and we share it all over the place on social media. If you can, go ahead, throw up some likes, give me some love. I'm always looking for some love, right? I would greatly appreciate it. And if you hate me, if you hate what I'm saying, you think I'm totally wrong, slam that in the comments too. I always want to hear from you. I want to find out if there's ways for me to get better. I want to hear it, okay? So go ahead and do that too. Hopefully it's more love than hate, but I'll take either, okay? So let's get into the net lease stuff, all right, and why it's important. Okay, so let's talk about the 7 points about what makes net lease so special. Then we'll get into, as I said earlier, the pros and cons. So if you're interested in doing net lease, the cool thing to understand, first of all, is what is net lease. You're going to hear a term. I remember when I was first starting out in this whole business, this triple net lease, triple net lease, triple net lease. Everybody kept saying triple net lease, right? And triple net is not triple net. It's not always triple net, okay? Triple net meaning net, 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 where the tenant is picking up the tab for the taxes, insurance, and maintenance. TIM, think of TIM, okay? Taxes, insurance, maintenance, okay? And not all deals are triple net. Just because you see an Advanced Auto Parts sitting on a lot, right, with asphalt lot, nice building. They don't actually own the building. Landlords like us or partners like us would own that building, right? It's not triple net, okay? But it's referred to as triple net by many, many brokers, many investors, okay? What defines the triple net is what it says in the lease, in the document. That's how it's defined, because that is truly what it tells you what type of net, who's covering the nets is what you really want to know, right? So the cool thing about net lease is that if you understand how to read the lease and you get how it works, okay, yes, in some cases, the tenant covers all those things, okay? And the lease will tell you that. Sometimes they only cover double, and I think it's a double net lease. I find, or we found, at least in some of the deals, or most of the deals that we look at, a lot of them are double net, right? Most of them are double net leases, right? But as I said, you know what? We'll look at any type of deal, and if it makes sense, we'd totally go after it. If it makes sense to do so. So net lease properties, they usually provide a lower cap rate to investors. Okay, that's one thing to note. Now, the reason why I mention that is because we do, as I mentioned before, multifamily, okay? With multifamily gives you a very different risk tolerance compared to net lease. If we're gonna start drawing comparisons here, okay? In multifamily, you're able to go into a property, you're able to improve the property, you're able to turn the units, You're able to, like say they have wood or Formica counters, get rid of the Formica, put in granite, put in a nice sink in there with the crazy pull-out faucets and all that fun stuff. You can do all that and drive the overall value of the asset, because when you do all that stuff in the right asset in the right location, you improve NOI, net operating income. When you improve the net operating income, it increases the overall value of the asset. The cool thing, though, is that as someone like us that buys these deals, we have complete control of the asset. We have complete control of who lives there. We have complete control of the leases. We have complete control of everything. Compared to a net lease deal, we may have some control over certain things, depending, again, on what the lease says. But for the most part, the tenant that's living, quote, living at that unit is going to really define what happens at that asset, okay? So the tenants that usually, the ones that we go after anyway, when we buy these assets, Dollar General, Dollar Tree, Walgreens, CVS, Advanced Auto Parts, you're talking VCS, the Animal Hospital Company, these are all corporate or franchise-backed companies. Multi-million dollar companies that are backing up those leases that promise they're going to pay every single time. Okay, that's the difference between the types of deals that we do versus the mom and pop type scenarios where we just don't do those types of deals. There's a clear difference though between multifamily and net lease. Okay, sure, on the multifamily side, the returns could be greater, could be good, right? On net lease, however, you're not doing net lease to get to become a billionaire overnight. It doesn't work that way. Okay, net lease gives a risk-adjusted return. That means that we deliver a steady monthly return every single month, very, very predictable, right? Why? Because the tenants who are in those locations, again, Dollar General, Family Dollar, those types of guys, they want to protect their credit. They like keeping their credit rating high. Okay, it makes them more favorable to Wall Street, makes them more favorable to their investors. They're able to raise more money to continue operating when they have good credit. So paying their leases makes a big difference to them, right? They want to make sure they do that. It's extremely predictable. So predictable that we deliver monthly returns. That's how predictable it is. On the multifamily side, not always the case. We do quarterly returns on those, and that ebbs and flows depending on what's happening. Maybe you have some tenants move out. Maybe you have a boiler that blows up. Maybe you have a maintenance issue of some sort that slows down the return. But we always hit the annual return target. We always do that. But the quarterly is going to be somewhat choppy, and that's okay. You're giving up a smaller return on the net lease side but for consistency is what you're doing, right? And the cool thing about net lease, though, is that if you're able to build enough net lease, either you're investing with a group like us or you buy your own, it's extremely predictable. Like I said, extremely predictable, right? So we're going to talk a little bit more about like how do you buy these types of things too, right? So we're going to get into some of that. So if you do want to do your own deals, go nuts. But I think you're going to understand by the end of this why you want to understand why it's not always such a good idea, okay? So like I said, net lease properties, they usually provide a lower cap rate, but investors love these properties because, again, not only is the cash flow very consistent, you don't get the headaches of dealing with the tenants, the termites, the toilets, all that stuff, the maintenance issues that come with the property, all that fun stuff, all right? So, but here are the 7 points that I mentioned earlier, all right, about why real estate with net lease, okay? Number one, we've already discussed this before. If you've been following me or the channel for any length of time, you know that I'm a big fan of real estate. It's the most proven asset class ever, right? There's nothing else on the planet like it, okay? Crypto, stocks, ETF, none of that stuff has any bearing on real estate, right? They cannot beat real estate. And I know there might be some fanboys out there saying, "What do you mean? My what is it? My Gorilla NFT coin is so awesome." Nah, not so much. Why? because you have the tax benefits. We're going to get into that too. The tax benefits, depreciation, all the really good things. And when you're buying real estate, you're buying a real asset, right? Assets that have been around for hundreds of years. Some of the assets that we bought have literally been around for over 100 years, right? They're not going anywhere. You can't say that about some currencies. You can't say that about any other stocks. Can't say that, right? Secondly, net lease properties, they offer mailbox money, okay? Where the tenant will handle the taxes, insurance, maintenance, usually, depending on the lease, okay? Number 3, net leases require less work to manage compared to the multifamily assets that some of the assets like we own, right? There's very little overhead when it comes to doing the net lease deals versus multifamily, okay? Again, it also depends on how you buy these assets too. But for the most part, we own a bunch of these net leases already. We manage them. It requires way less overhead to run that portfolio than it does for any other asset that we own, right? So it really is great in that regard. Net lease properties are particularly enjoyed by the investors that we have just because of what I mentioned before, TIM, tax, insurance, maintenance, okay? When they know that all or some of that is covered by the tenant, you know that the expenses are going to be somewhat controlled or somewhat in line, right? You know, especially when you budget, when we do is we budget for certain things that might happen at the property. It's very easy to make very predictable returns based on that. The tenants, number 5, okay? The tenants that live in these assets are strong tenants, okay? Again, some of the companies that I mentioned before, publicly traded usually, or they have a strong either nationwide or regional presence. Strong tenant, they're very, very stable, they're very reliable, they are interested in protecting their credit, and they have a responsibility to the asset too because the lease says so. So this gives us security in knowing that the tenant's going to be there. They're not going to just leave in the middle of the night. They can't because there's a lease. Even if they did, if Starbucks decided they're gonna ignore their 10-year lease and drop out, if the lease says they have to pay for 10 years, they end up paying for 10 years. They have to abide by the rules of the lease. That's the cool thing about it, right? That's why we love these deals so much. Number 6, net lease properties offer that consistent and regular cash flow. Gives you the ability to get that cash every single month and preserve wealth. 2 big things right there, right? You get that cash flow every single month, okay? And when you put that money as either as an LP investor in our fund or you do it on your own, the asset itself stays very stable too, right? And again, depending on, hopefully you're doing the right types of deals because there's many different types of net lease deals out there, but the deals that we're going after, we're buying the building, we're buying the land, and we also get the lease. We're getting the whole stack, okay? That means that we get that consistent cash flow. As long as we make the tenant there, we keep them happy, and we stay on top of the maintenance whenever they ask for it. If we're covering something, and we're good landlords to them, and of course they're making their number in terms of sales, they're going to stick around, right? And the cool thing about it is that as long as the building's kept in very good shape, it's secured by the real estate, whatever money you put into the deal. So it's a great deal in that regard, right? And number 7, you're able to leverage very unique benefits through the mortgages that you can get on these types of assets, okay? And we already know that real estate's a hedge against inflation, but I think it's worth mentioning the mortgages. Listen, right now, lenders have tightened their belts a little bit because of where we are in the economic cycle. However, in our case, what we've been able to do is we've been able to do 2 things. Number 1, the lenders that we approach to do our deals, they love net lease. They love net lease. We're able to get somewhat decent terms with still 30-year amortization in some cases, okay? Some lenders don't like doing like multifamily right now with that type of deal. It's going to be at a higher leverage. It's going to be 25-year amortization, again, depending on the size of the deal, very, very, very expensive money. But for a lender that's doing, like, say, we just recently bought a Family Dollar, they like Family Dollar. They know Family Dollar. They check them out on the stock exchange. They see them there. They see how healthy they are. They'll do that deal all day long. They love doing those deals, right? And they'll even give you high leverage on those deals too. It's great, So we can usually get very good mortgage rates on our deals. Although recently we've done a lot of owner finance type of deals too, right? So how do we swing that deal? Interesting. We swing that deal because the seller who's been in that deal for a long period of time, they don't want to get smashed with taxes on that deal. So what they will do instead is finance the whole deal, and then they get paid out over time. Then eventually there's a balloon after some length of time, depending on what we negotiate. But for the most part, it's always at a very favorable rate, and we still get that 30-year amortization, usually interest only. The investors get to enjoy that big, thick, fat income coming in every single month. It's phenomenal, right? So we love doing those types of deals too. So like I said, there's many ways to get into the net lease space. I already talked about two specifically. One is either go out and do them yourself. Secondly, of course, you can invest in some of the stuff that we do. My team and I, what we do is we have what's called a blind pool fund, and we might buy 10, 15, 20 of these locations in a single fund over some length of time, and we distribute this money in, I'd say, somewhat investor-friendly, landlord-friendly type of places. So we're able to spread what little risk there already is in doing these types of deals over multiple places. And because we have set processes and procedures on how to underwrite these deals, we're able to severely de-risk the situation too. So, and let's get into that though. Let's talk about the pros and cons of some of these deals. Okay, so let's talk about the pros. On some of the longer term net leases, you can sometimes get 15 to 20 years written to the lease, which is phenomenal, right? 15 to 20 years, depends on the lease, right? We're doing something unique right now called a blend and extend model. And what that means is that we're getting leases with a fairly short time horizon left on the current lease, but we know that there are extensions available, and we know that the market that asset is located in is strong. So those are two things we primarily look for. We feel very, very comfortable about the VPD, the vehicles per day in that immediate area. We feel good about the foot traffic that's going in and out of that place. We feel good about the business that's in there. If we can, we try to get our hands on their numbers, their financials. They don't always release all that stuff, but sometimes they do. And if they do, and we see that they're steadily growing their business, it's still very busy. They're earning money, they're making money, and if they're making money and they're happy, they'll tend to stick around, provided of course that the building itself is in good shape too. So we do look at the asset and what condition the asset's in, because if the asset itself is in not so good shape, something else to consider, right? Okay, so that's a pro. Another pro here is very little landlord responsibility. Okay, the tenant pays usually some or all the expenses, some or all the taxes, some or all of the insurance or repairs. It all depends on what the lease says, but typically for the most part, for the deals we've done anyway, very little for us to do. Okay, another pro, very stable cash flow. One of my favorite things I love about this business is that you get the stable cash flow that keeps rolling in with these deals. It's one of the reasons why we started this segment in our business, was because we wanted to offer our investors the ability to get stable cash flow while they're invested in some of our other stuff, if they wanted a monthly return, to really protect their income and also protect their money coming in as they are maybe working a full-time gig and they're worried about things at the office. They can still get money coming in. Another pro, low turnover due to the long-term lease. Now, I mentioned before about the number of the what's in the lease, right, in terms of the renewal periods, right? So usually the longer the lease, the smaller the cap rate, general rule of thumb, right? In addition to how much the cost of the money is. But for the most part, you know what? If you're in a thriving, nice, strong area, and that tenant's been there for a long period of time, chances are they'll probably stick around. They'll stick around for some length of time. Now let's get into the cons, okay? The cons of these types of deals. When the lease ends, the tenant can move out, okay? And it could leave the property vacant. So that is definitely a risk. So going out on your own and trying to buy a Dollar General on your own you can certainly do it, but you really, really, really have to be good at underwriting the deal, underwriting the tenant, see if you can shake the person down or shake the manager down for the sales. They don't have to give it to you. If you don't have a relationship with HQ, with the office, they may not even give you the financials to the deal, right? There's all kinds of things that can happen if you're trying to do this on your own. So because we have experience doing these types of deals, and I touched on this a second ago, we have access to a lot of data that tells us how strong that area is, how strong that location is in some cases, right? And we can sometimes determine by foot traffic, right? What type of asset it is, like say it's a Dollar General, right? The tenant that's at that location, and we know roughly what the ticket sales are, and we know that the X number of people visiting that location. We can sometimes estimate how much money they're making daily, weekly, monthly, yearly, right? We try to de-risk as much as we can, in addition to also figuring out if they vacate, who can move in there. We look around to see what other type of business in this area is not here or would want to locate here. We look for stuff like that, okay? Due diligence on these types of deals is certainly not easy, all right? But the cool thing about it is that when you do it that one time and you make a strong investment, that's where the money is made, when you acquire the asset, okay? There's very limited upside as far as lease terms are concerned, okay? And you can't just go for a rent increase whenever you wish. That's a big thing right there for many, many people, right? It's very different than doing your residential, right? With a residential, you can just say, we're increasing the rent. Here you go, right? You get a bunch of upset tenants shaking their fists at you, oh my God, I'm so upset about that. Shake all you want, you signed a lease, sorry. If you want, you can move out, whatever, I'll put someone else in there, if you really want to, if you're that type of man, of landlord, right? The thing is though, with net lease, you don't have that flexibility. You give up that flexibility, right? Whatever it says in the lease is what it is. So on renewal periods, you can sometimes negotiate or renegotiate those types of things, okay? So that's something you can do, right? There are ways that you can help that situation. But again, it comes down to knowing how to do that kind of stuff. That's probably the thing, right? You really have to know and understand how to put that together and who to talk to. I know I just mentioned leases. Here's another con, is that not all net leases are created equal, okay? Here's what I mean by that. This is wild. You'll have a Dollar General and another, maybe 5 miles away, another Dollar General, and it could be the same owner, right? Chances are that owner is looking at two very different leases from the same company. Now, how would that happen? Well, a lot of it has to do with when they were built, who was working at Dollar General at that time handling that lease, right? We've seen leases that were written back in the 1950s, and they've just been renewed, and all those. So we get the original lease as well as all the amendments that come along with it. So that's been very interesting, right? We've seen stuff like that. So the thing is, though, is that not all leases are created equal. That means that your counsel, your attorneys, have to go through all the information all over again every time they're looking through a lease, right? We have to do it. Usually we do it, and then our general counsel does it to try to find any gotchas that we might have missed. I mean, it's a whole process, right? So it's one of those things that it does cost extra money to do that. If you have a scenario where you're very familiar with the lease and your attorneys are very familiar with the lease from the same company, then it makes things a whole lot easier, right? But it's never the case with these types of deals, right? So that's the pros and cons. So the reason why I mention it again is because you really have to know what you're doing to try to reduce the cons as much as you can. I mean, the good thing is that you are investing in real estate. It's a real asset. You're getting the land, the asphalt, the asset, the building, you're getting the lease, you're getting all these things all the way up and down the capital stack. You're getting all that, right? The whole thing. That's what makes it such a great deal, right? So I'm going to take a pause here for a second. And I just want to say that if you're digging on what I'm saying, it's all resonating with you, please, if you're watching this on YouTube, which you probably are, throw up a like, give me some love. I would greatly appreciate it, especially if you made it this far. I'm talking a lot about some of the pros and cons here I'm going to get into. Now, what sort of people get into these types of deals next, okay? So thanks again for sticking with me, okay? So let's get into who does these types of deals and why do they do it, okay? So investors are looking for stable cash flow without the day-to-day property management, I find, are the ones that love doing these types of deals. They're the ones that like doing this stuff, okay? I love multifamily. It's great. It's a very different animal compared to development, compared to net lease, compared to single family, compared to self-storage, compared to all the other different asset classes, right? All of them. Every single one has their pros and cons. I found that net lease is among one of the ones that has the lowest type of risk. That's why we went that route and added this to our portfolio so we can offer our investors, the investors that want steady cash flow, risk-adjusted cash flow with very little responsibilities or risk, is perfect for doing that kind of stuff. Okay, it's perfect for it, right? So the cool thing about it is, just like with all the other real estate that we own, you still not only get the benefit of that cash flow, you still get all the tax benefits that come along with real estate in general. So sure, you're not going to get the crazy cash flow you get in a multifamily or like the big juicy squeeze of a development. You're not going to get all that. It's okay. You know, if you want to have a nest egg of cash, just an asset that keeps on throwing off cash every single month, that you don't have to worry about, that shows up extremely predictably, it just shows up in your account like a genie. It's there to, little genie shows up and hands you some dollars. Nothing wrong with that. It's cool. I like that. You know, and you should too. So that's why I like that deal so much. That's why I love that deal so much, right? And the cool thing about it too is, when you know it's predictable, you don't have to worry about it. You know that cash is going to be there to make your car payment, make your house payment, take care of the kids' schooling, whatever they need. The more assets you buy, the more money you invest in these types of deals, the more that steady cash flow will just keep on rolling in. Okay. This deal is also perfect for those that just want to park their money and get that consistent return in a deal that's very, very stable. Okay. It's extremely stable. How do you get into this business? Okay. I already talked about two ways to do it. Okay. One, you can do it yourself. You can get in, you can try to do all the due diligence. You can do all that. It's a lot of work. You really have to know what you're doing. Or number two, you can get into an LP type of situation, right? You invest as a limited partner in a deal, okay? So like I mentioned before, we have a blind pool where investors can come in and they partner with us on doing deals, right? So like I said, we're getting into these, we're buying like 10, 15, 20 of these locations, various stores, various assets across multiple places, right? And while we do a very good job with our own due diligence, we're also spreading that risk across multiple assets in very landlord-friendly states, right? We're specifically looking for that too, okay? So it gives our investors the comfort in knowing that every single month that check keeps rolling in and they don't have to worry about it, And if one of these deals does vacate, it's not a problem. It's okay because we're very comfortable in doing the deals that we are doing, and we know that we can find someone to come in and backfill that location, right? So those are the types of deals that we do. So there's two ways to do it. Listen, you can always jump in, learn the deal from the inside, and then if you did want to go do your own, you can. I mean, it's certainly true. You can do it yourself, right? In either case, you still get that steady return. You still get tax efficient returns too, right? The same thing still applies in both cases. and you still get the depreciation. The difference is that you're going to be busting your chops trying to do it yourself and have to learn the entire process versus having pros that have the systems and the technology and the know-how and all the relationships to make that deal happen, right? So there's two different ways of doing it. So that's very important. Now, here's the thing, all right? If you have questions about how to do this type of business and you're curious about it, all right? If this thing's on YouTube, which it probably will be, go ahead and leave a comment. I'll get notified that you want to talk about something or you have a question about this presentation. It's perfectly fine. Or go to bulletproofcashflow.com, drop us a note there, or find me on Instagram. Send me a message. Always happy to talk to people about deals. I love doing deals. I'm a deal junkie. I like doing good deals. We don't do dumb deals. Known for that. So that's a really big important thing for me. So anyway, like I said, drop me a question, drop me a line. I always like to hear from you. If you have any questions, please do so. All right. That's all I got. Throw up some love. Like I said before, give me a like, give me some love. I will talk to you again soon. All right. See you next time.